Welcome to Whole DNA. This is the part 3 of our advanced option strategies course, and in this part we are going to discuss a bearish debit option strategies that is called bear put spread. So as the name suggests, this is a bearish strategy. It involves puts, and this is a debit strategy, so it involves buying net buying options. So just let us begin. So this is a disclaimer. All the materials presented to you here is for your informational and education purposes only. Kindly do consult your financial advisor before taking any trades. So what is bear put spread? What are its characteristics? So this is a bearish strategy, as the name suggests. This is a debit strategy, so it involves buying net options, that is you are paying a net premium to the option seller. And of course this is a directional strategy. The difficulty level, this strategy is for beginners. All of those who want to play in bear markets, or they want to short these stocks or play in the falling stocks, and this strategy is best for them. Of course the profit level is limited and the risk level is also limited. That is why this option strategy would be the first strategy for the bear traders who want to play in the falling markets. So what is actually bear put spread and when to use it? So bear put spread involves buying at the money or around at the money put options and selling out of the money put option. So supposedly a stock is currently trading at $100 and you are hoping that this stock is going to fall. Then what you can do is you can buy a put option around $100. Let's say you buy a put option for $99, and you don't want to buy naked put options because they have very high theta decay, and in case stock remains sideways or go upside, you will lose all your premium. So in order to counter that, what you can do, you can sell further out of the money put option. So you bought $99 put option and you sold $95 put option. Why we are selling this put option $95? There are two reasons: to reduce the theta decay in the option and to reduce the maximum loss. So when you are selling that put option, you require your premium requirements, and also it do limit your profit potential, but it also reduces your downside risks. So when should we use it? This strategy should be used when you expect a stock to fall and it will go down gradually, and you're hoping that this stock is not going to fall below a certain level of support. Supposedly you are watching the chart of a stock and there is a support on, let's say, 95 $94. Then in this case you should use this bear put strategy. Otherwise, if you are very confident of a fall in the stock and you are expecting that there is going to be a free fall, then instead of bear put spread you should buy naked put options. So this strategy should be used when you are moderately bearish on this stock and you are also skeptical about fall beyond a certain level of support. So this is the bear put strategy. So this is a pictorial example of what we have discussed earlier. He is a person and he is hoping that this is a stock which is trading at $100 and is going to fall, but it will now not go beyond $90. So he want to play in option, but what should he do? He can buy at the money put option and sell slightly out of the money put options. So what he does, he bought one lot of put option for $100 strike price for $3 per option, and he sold $90 put option for $0.50. So he net paid a premium of $250. $3 minus 0.50, that is $2.5, and there is a 100 lot, we are assuming there is a lot of 100, so he paid a net premium of $250. This is his maximum loss. because in debit strategy you cannot lose more than what you have paid in the premium. So his maximum loss is limited to $250. So what would be the different scenarios on the date of expiry? Let us analyze. Supposedly he was predicting that this stock is going to fall, but what would happen if the stock does not fall and it will remain $100 or above? What will happen is that both the option will expire at $0 and he will lose his entire premium, that is $250. What would happen if the stock stays at $97.5 on the expiry? I have taken this $97.75 because he paid a net premium of $2.5. So $97.5 would be his break even point. So at this point the $100 put option will expire at $2.5 and the $90 put option will expire at $0. So he will net receive $2.5 and his profit and loss will be nil. What would happen if the stock expire at $90? The $100 put option will expire at $10, the $90 option will expire at $0 and he will receive net $10 on the expiry. So what would be his profit? He collected $10 on expiry, he paid $2.5 on purchasing the option, so his net profit will be $750. So this is his maximum loss, because now the stock has reached the strike price of sold put option. So beyond this point his profit is limited to $750. In this case you can verify it. If the price goes to $85, $100 put option will expire at $15 and the $90 will expire, $90 put option will expire at -$5. So he will again receive only $10 at expiry and his profit will again be the same. So this is just the profit and loss scenario of bear put spread on the date of expiry. Hope you have understood it. So what are the initial Greeks of bear put strategy? You know, if you are new to the Greeks or does not know in depth what are Greeks about and how to measure them and how to use them, I do recommend you to kindly watch our previous playlist in which we have discussed Greeks at very depth level. And I am assuming here that you have somehow a basic knowledge of Greeks, and in case you want additional or advanced knowledge on Greeks, I do recommend you to watch our Greeks playlist. So what would be the Greeks of bear put spread? So the initial delta of this strategy would be negative. It means you want stock to fall. It is very very easy to understand. Gamma, as this is a net debit strategy, the gamma is positive. That means any gapping move on downside will not create any problems for your strategy. So gapping down move is not a problem for your strategy. Theta is of course negative because this is a debit strategy, and in case nothing happens your position will lose daily decay. Okay, what is Vega? So it is a debit strategy, so it is a positive Vega. If IP goes up, it will be profitable for your position. So these are the initial Greeks of the bear put strategy. So how this strategy earns or loses with respect to change in the stock price, we will discuss it here. So this is the break even point. In our example, this was the price of $97.5. That means a strike price of bought put option minus net premium paid. So what would be the payoff chart? In case the stock starts to falling, your strategy will starting to earn profits. And beyond this point, what is this point? This is the strike price of sold put option, that is $90 in our case. So beyond this point your profit will be flat and it will be limited. Similarly, in the case of upside, if the stock started to rise, what would happen is your position will start to lose, and ultimately its maximum loss will be limited to $2.5 per option. So your maximum loss is limited to $250. So this is just the payoff chart of the bear put strategy, a simple one. If the stock starts to falling, your strategy will earn, and in case stock start to rise, your strategy will start to lose. And in this strategy, both limited profit and both limited losses. So max loss is net premium paid, max profit is achieved when the stock reaches the sold put option strike, that is $90 in our example, and break even point is again bought put option strike price plus net option premium paid. So how bear put strategy is adjusted. So this is an important part. When we expect a stock to fall or rise, there are a greater number of chances that we are wrong. So this do happens in financial markets, because if the markets goes with you, you can be a billionaire overnight. So things do go wrong. When we are hoping a stock to fall, it will rise. When we are hoping a stock to rise, it will fall. So these things happen in financial market. So how to adjust this strategy? You are hoping that this $100 share will go down, but instead of going down, let's say it went to $102. So what should you do? Because your strategy would be showing losses. So what should you do? So we will discuss it here. So as this is a debit strategy, bear put spread, maximum loss is limited to the net premium paid, and in the maximum cases, trade should be closed when the market moves in opposite direction, that is upside. So you are hoping for this stock to fall, and suddenly this stock is starting to rise. So how will you adjust this trade? It solely depends on your perspective, but you are hoping that what this stock is going to do next. So based on your conviction, you can adjust this strategy as follow. So if you are not bearish anymore, so supposedly this stock was at a resistance of $100 and this resistance was broken, and you are now hoping that this stock is going to the moon. So this stock is going to the rise, so you are not bearish anymore. So what should you do? Take the losses and close the trade. These things happen. You should accept that you are playing a bet on the markets and the bet goes wrong. So nothing bad, just close the trade and take your losses. What would happen that you are still confident of falling? You are hoping that this might be the false breakout, and this stock, you are confident that this stock will come down. So what you can do? So you want to limit your upside losses. So in previous payoff chart, we have looked at how the strategy loses. The strategy loses when stock starting to rise. So you want to protect this loss. You don't while adjusting, the first principle is you should protect your maximum losses. So you want to protect your loss. So what you can do, you can sell more lot of OTM put option that you have sold in first place. So what you will do, earlier you bought a $100 put option and sold $90 put option. So what you can do, you can sell one more lot of this $90 put option. What will this do? This will reduce the debit of your strategy, or even you can make this a slightly credit strategy. So it will protect your upside, as the loss is always limited to the net premium paid, and also this reduce the theta decay of the option, because now this strategy is a less debit. The new payoff chart will look like ratio spread or broken wing butterfly, and however it will increase the margin requirement substantially. So what would be the new payoff chart of this adjustment? This will look like this. Your upside losses are reduced, your downside profits are still intact. However, what this strategy does, that this strategy opens your downside losses. So in case the stock moves below $90, your strategy will starting to lose. So this is the prospective adjustment of bear put strategy, and this should be implemented when you have sufficient margin and you know how to handle net credit or slight debit strategies. So again, the max profit is reduced due to selling extra put option, which you have reduce the margin, reduce the premium paid for the options, and the maximum loss on downside. Now I have to put it upside here, because maximum loss was protected from upside. However, when you are short net options, the maximum loss is uncapped on downside. So this was the adjustment of bear put spread. a simple one. In case the stock goes up, however you're still confident that this stock is going to fall, what you can do, you can sell extra put option in order to reduce your premium paid and reduce your theta decay. What will it do? It will, limit, it will reduce your upside losses, it will remain intact your downside profits, however it will do open your downside losses beyond the sold put option strike. So this was the adjustment of bear put spread, and with this we conclude our bear put strategy. In case of you have any query, please do comment below, and I request you to kindly subscribe our channel for upcoming new strategies. So thank you for watching. In case you like, you can visit our website voltdna.tk and do follow us on Twitter at that volbusy, where we post daily market updates, daily emerging analysis, emerging opportunity in the financial market. So thank you for watching.